Thank you, Mr. Chairman. Just to correct the record, Kentucky and the Wildcats. Wildcat fans will be offended to be associated with the Volunteers, but thank you, Mr. Chairman. And thank you to our witnesses. You know, it never ceases to amaze me. I've only been in Washington for a little over 2 years, but it never ceases to amaze me that Washington doesn't seem to be able to learn the lessons of history and recent history. So here we have Fannie Mae and Freddie Mac jumping back into offering 30-year loans for borrowers that can only afford a 3% down payment. These loans are exempt from the requirements that another federal agency says are required in the qualified mortgage rule, the Consumer Financial Protection Bureau, that are supposed to prevent a recurrence of loose lending. And now the FHA has reduced its premiums in a move designed to expand its market share, but certainly is going to hurt its capitalization. And lowering these premiums, the FHA is once again luring people who are unprepared for the obligations of home ownership into risky loans they're unable to repay. And this risk goes right to the taxpayers. So to Ms. Gordon, let me start with you. In an August 2012 white paper that you co-authored for the Center for American Progress, you will recall that is entitled, "It's Time to Talk About Housing." You decried the practice of loan originators who steered borrowers into risky subprime loans, even when they qualified for better loans, citing predatory pricing gimmicks that both encouraged borrowers to borrow far more than they could manage and required the borrower to refinance every couple of years. You noted that such loans tended to default at significantly higher rates than conventional mortgages. So now let's look at what the FHA is doing, employing pricing gimmicks, exceedingly low down payments, low credit scores, inadequate upfront pricing, high maximum dollar value loan limits, and the FHA loan default rate is nearly 150% higher than prime loans. And I've read that FHA loans are defaulting 1 out of 8, right? So why isn't the FHA's practices squarely within the subprime practices that you decried in that 2012 white paper?
Actually, first of all, let me correct the record. FHA is not exempt from the Dodd-Frank mortgage rules. That is a very important point. The Dodd-Frank mortgage rules put a floor under this market that did not exist before. Had the Dodd-Frank mortgage rules been in place in 1995, we would not have had the crisis that we had. FHA has to abide by the ability to repay requirements. FHA has a qualified mortgage safe harbor that is extremely similar to CFPB.
Similar. Let me jump in right there, because I've asked this question to Secretary Castro, and he acknowledges it's not the QM rule. It's a different rule. It's a different underwriting standard than what the Bureau says is a qualified mortgage.
It is almost identical. The reason it is different is because the statute tells FHA to do its own QM and specifically says the CFPB is doing a QM for the private market.
Let me jump in there and let's follow on this theme of a double standard, okay? Because it is very troubling to me that Washington continues to live by one set of rules while they impose an entirely different set of rules on the private sector. And to Mr. Gupta, I want to just ask you, so the capital reserve requirement by law for the private mortgage insurance industry is 4%, could go up to 8%.
Yes.
And the rule for the FHA is 2%, which, by the way, they can't even comply with.
Yes.
Totally different rules apply to the government than apply to you. And the rules that apply to the government, which are different than the rules that apply to the private sector, the government is in non-compliance.
Yes, you're correct, Congressman.
Even though they get a bailout. Do you get a bailout, a $1.7 billion taxpayer bailout in the private mortgage insurance industry?
Yeah.
This is a double standard. The American people are tired of Washington living by one set of rules and the private sector and the American people living under another set of rules. Let me quickly go to Dr. Rossi. I was interested in your testimony, speaking of applying the same set of rules to the government. Your recommendation that there be qualified mortgage rule harmonization, can you amplify that testimony?
Yes, I can. So with regard to FHA, for example, today it's my understanding that they allow lenders to as long as there are compensating factors to actually underwrite the loan. So they're actually relying on the lenders to do the review here for DTI's debt-to-income ratios above the bright line 43% test that's in QM for everybody else.
So you would disagree with Ms. Gordon that
There's a different set of rules.
Actually, right now, almost all loans go through either GSEs or FHA, and GSEs also permits loans over a 43% DTI if there are compensating factors, and they also leave the underwriting up to the lenders. So frankly, it's exactly the same across the vast majority of the book right now. And I should also add, since you quoted me, I would like to correct the record, which is the kinds of loans I was talking about in that August 2012 paper, those are precisely the kinds of loans FHA has never done. FHA has always required underwriting. It does not have pricing gimmicks, and it does not have steep rate resets.
Mr. Gupta, I think you wanted to comment on that.
I would agree with Dr. Rossi that for FHA, greater than 43 DTI is permitted because that's the rule they make. And for private label securities or for portfolio loans, a bank would actually not be permitted to actually use that rule. So FHA does have an advantage in terms of creating their own definition of QM that also applies to the definition of safe harbor applied on annual percentage rate. So FHA actually calculates that safe harbor coverage differently than private label securities.
Thank you. I yield back.